Most people think they lose money in investing because of bad market timing or poor stock picks, but the truth is far deeper. You don't lose to the market, you lose to your own mind. Fear, greed, overconfidence, and impatience quietly sabotage your decisions long before any market crash does. The world's best investors aren't the ones who predict the market. They're the ones who control their emotions. In this video, you'll uncover the hidden psychological traps that make you take the wrong decisions, and the techniques that can help you think like a disciplined, profitable investor. If you understand your mind, you instantly become a smarter, calmer, more strategic investor than 90% of people. Your thoughts shape your decisions shape your habits, and your habits shape your financial destiny. You don't need to be a genius to become wealthy. You just need to avoid the emotional mistakes everyone else makes. The investors who master psychology stay consistent even when the market tests them, because the truth is, your biggest enemy is not volatility, it's your reactions to it. Once you take control of your mindset, every investment decision becomes clearer, stronger, and more profitable. 1. Fear of loss. Loss aversion. Humans fear losing money twice as much as they enjoy gaining it. This causes investors to panic sell good assets, avoid opportunities, and hold losing trades for too long. Loss aversion creates emotional reactions instead of rational decisions. Wealthy investors counter this by following predefined plans, not feelings, allowing them to stay calm during volatility and capture long-term gains. Fear of loss also tricks you into believing that avoiding risk is the same as avoiding danger. But in investing, avoiding risk often creates danger by limiting your growth. This fear makes you focus on short-term pain instead of long-term progress. It pushes you toward safe decisions that hurt your wealth over decades. The only way to beat loss aversion is to trust a strategy, not your momentary emotion. 2. Overconfidence. Bias. Most investors believe they're smarter than the market until the market proves them wrong. Overconfidence leads to unnecessary risks, excessive trading, and ignoring warning signs. When you assume you can't be wrong, you stop analyzing objectively. Successful investors rely on data, systems, and rules, not ego, which keeps them grounded and consistent. Overconfident investors often chase returns without understanding the risks. They confuse luck with skill and mistake temporary success for permanent mastery. This mindset exposes them to bigger losses when markets shift unexpectedly. The truth is, humility is more valuable in investing than intelligence. The moment you believe you're unbeatable is the moment you lose the discipline that actually makes you money. 3. Herd mentality, FOMO investing. When everyone is buying, you feel like you're missing out. When everyone is selling, you feel like you should run too. This herd behavior creates bubbles, crashes, and emotional chaos. The most profitable investors usually do the opposite of the crowd. They buy when fear is high and sell when excitement peaks. Following the herd gives you comfort, but it rarely gives you profit. Crowds typically react late. They buy after prices rise and sell after they fall. This emotional timing kills returns and destroys discipline. History shows that the crowd is almost always wrong at major turning points. Standing apart feels uncomfortable, but that discomfort is exactly where opportunity grows. 4. Recency bias. Short memory investing. If the market rises for a month, you assume it will always rise. If it crashes once, you assume it will crash again. Recency bias blinds you to long-term patterns and makes your decisions short-sighted. Great investors zoom out, study decades of history, and avoid making emotional choices based on last week's headlines. Recency bias also traps you in cycles of fear and overconfidence. You forget that markets move in waves, not straight lines. A single month cannot define a long-term trend, but emotionally, it feels like it does. This bias causes you to overreact to noise and ignore fundamentals. The best investors train themselves to think in years, not days. 5. Wanted confirmation. Bias investors love information that supports what they already believe and ignore anything that challenges them. This traps you in a bubble where you only see what you want to see. Confirmation bias leads to misjudgment, poor risk management, and blind loyalty to bad investment. Smart investors actively seek opposing opinions. They challenge their own thinking before the market does. This bias makes you emotionally attached to your predictions. You begin defending your ideas instead of evaluating them. It encourages stubbornness, not intelligence. Overcoming confirmation bias requires curiosity and humility, two rare but powerful traits. The investors who grow the fastest are the ones willing to admit, I might be wrong. 6. Anchoring bias. You anchor your judgment to the first price you see. If a stock once traded at $100, thus you think it's cheap at $70. Even if the company is collapsing, Anchoring creates unrealistic expectations and emotional attachment to numbers. Experienced investors focus on value, fundamentals, and trends, not outdated prices. Anchoring also makes you hold on to unrealistic targets. You wait for a losing investment to return to its old price, ignoring the new reality. This prevents you from cutting losses and reallocating to better opportunities. It tricks you into believing the past defines the future, but markets don't work that way. Breaking anchoring bias frees you to make decisions based on logic, not nostalgia. 7. The pain of waiting. Impatience. Most people want fast results, quick profits, and instant growth. This impatience makes you chase trends instead of building wealth slowly and consistently. The real psychology of investing is about resisting the urge to do something. Holding quality assets for years is harder than buying them, but that's where true compounding happens. Impatience destroys more wealth than bad investments ever will. It pushes you to switch strategies too often, never allowing anything time to grow. This creates emotional burnout and financial inconsistency. Investors who embrace patience naturally outperform those who chase excitement, because in the end, compounding only rewards those who stay long enough. 8. Emotional decision-making. Under stress, market volatility triggers panic, anxiety, and impulsive choices. Your brain goes into survival mode and treats financial loss like physical danger. This is why people sell at the bottom and buy at the top. The best investors develop emotional detachment. They follow rules, not reactions, and treat investing like a long-term game. Stress short-circuits your ability to think rationally. It makes every dip feel like the end of the world. This emotional pressure pushes you into decisions you later regret. Learning to stay calm during volatility is a skill, one that wealthy investors master early, because stability in the mind leads to stability in the portfolio. 9. The illusion of control. You may feel like you're controlling outcomes because you monitor charts or read news daily, but in reality, markets move independently of your attention. Believing you're in control makes you overtrade and overreact. Real investors control only one thing in their behavior, and that's what determines long-term success. This illusion tricks you into doing unnecessary things. You believe more activity equals more results, but the opposite is true in investing. The market rewards discipline, not constant action. Trying to control the market drains your time, energy, and confidence. Accepting uncertainty allows you to focus on what truly matters, your strategy. 10. The solution: build a rational investing system. The cure for psychological mistakes is not more knowledge, it's better structure. Create a system that includes a long-term strategy, clear rules for buying and selling, defined risk limits, regular reviews instead of daily monitoring. Systems eliminate emotional decisions and keep you aligned with your goals. Once you reduce emotional noise, your profits naturally increase. A strong system becomes your emotional shield. It prevents you from reacting to temporary fear or excitement. It keeps you consistent even when the market becomes unpredictable. With a system, your decisions become automatic and logical. And over time, your system becomes your greatest investing advantage. If this video helped you understand how psychology affects your investment decisions, now is the time to take control. Study your own biases, build a disciplined strategy, and train your emotions to follow logic, not noise. Hit the like button, share this with someone who invests emotionally, and subscribe for more content on mastering the mindset of wealth. Remember, the market doesn't make you lose money. Your decisions do. Master your mind and wealth will follow.